The two different types of wealth are people that are worth a lot of money, like Elon Musk, and then you have the strategy, which is you make a lot of money, like Warren Buffett. Let's break this down, starting with the worth a lot of money strategy. When Elon Musk was initially building Tesla, he needed to raise money from investors, and he gave investors a piece of ownership in the Tesla company. And as he was going out and raising money, what he asked for from the investors was not a big salary, which is what a lot of people want. In fact, what he said is that I will take from Tesla a $0 salary. Instead, I just want stock options. I want the option to buy ownership in my own company. What does that mean? Well, he negotiated that his payment would be 303 million stock options in the Tesla company, and he would be able to purchase these stock options at $23 a share. This is adjusted for stock splits that have happened. So, if he works to build Tesla and the stock price goes above $23 a share, well, now these 303 million shares are worth a whole lot of money. So let's do the math. When Tesla is trading for $200 a share, that means essentially each one of his 303 million shares or stock options is worth $177 a share, because he has to buy them for $23 and then he can immediately sell it for $200 a share, essentially meaning that he can buy these 303 million shares for $177 a share, which makes his stock options worth around $50 billion. Now, he has other assets as well, but his Tesla ownership at $200 a share is worth $50 billion. Now again, this is money that he doesn't actually have in his pocket. This is not money he has in his bank account. He can't spend this money, and the problem is, if he wants to spend this money, he would have to sell his stocks. And if he sells the stock, the first problem is you're gonna have a big tax bill, because if you make billions of dollars, the government is gonna want a lot of money in taxes. The second problem is he's gonna lose out on potential future upside, because if he believes, as the CEO of Tesla, that it'll be worth $300 a share one day, $400 a share one day, I don't know, well then if he sells his shares, he loses out on that upside. So he's worth a lot of money, but this is money he doesn't actually have in his pocket. He can't use this money to buy a car. He can't use that money to buy groceries. He can't use that money to buy a home. So how does he go out and live a fancy lifestyle? Instead, what he does is he takes out debt against this value right here. Think of it like a home that you have. You have equity in your home. You can do a cash out refinance. If you own a $500,000 home free and clear with no debt, you could pull out $300,000 of debt tax-free, like a cash out refinance. And that's what he does. He goes to the bank and says, hey bank, I have these 300 million stock options in the Tesla company. It's worth $200 a share. I can buy these at $23 a share. It's worth $50 billion. Will you give me a $1 billion loan? Will you give me a $5 billion loan? Many banks in this instance are gonna say, sure, we will give you whatever amount of money that you want. And now he has this money tax-free. Why is it tax-free? Because it's not money, it is debt. If you go out and do a cash out refinance, you don't pay taxes on the money that you get, it is debt. So now he has billions of dollars to spend. He can go out and buy a car, buy vacations, buy homes, buy whatever he wants, and doesn't have to pay a penny in taxes. Now, of course, here's the risk. He has to pay that money back plus interest, because it's debt. And so now he has to figure out how is he going to pay this money back. And so he has a couple options. He can either A, sell some of the stock to pay this money back, but then he has another taxable event. He can sell ownership in another asset that he has and use that money to pay this back. Or if the Tesla stock goes up in value, he can just keep refinancing. Because if he has to pay, say, 5% in interest on this debt, and the Tesla stock goes up by, say, 10%, he just made a profit on this money that he never had to pay taxes on. Now, of course, this is very risky, because if the Tesla stock gets cut in half because the stock market crashes and it goes down to $100 a share, well, now he just lost $25 billion of net worth. And so that is the risk with this game, because you're not spending money, you're living off of debt. And when you live off of debt, you are taking on the highest risk. Of course, you get tax benefits for taking on that risk, but you're also taking on the highest risk because if Tesla goes bankrupt, you have a whole lot of debt and no more collateral to back up that asset. So this is one way that wealthy people live lavish lifestyles and have their wealth is they are worth a lot of money on paper and then they can use debt relative to this asset that they own. However, this works for some people, but it's not my preferred option. And this brings us to option number 2, which is people that make a lot of money or the Warren Buffett strategy. So let's jump in. Warren Buffett isn't known for building a new car company. He's known for making smart investments and holding these investments for a long time. Warren Buffett is the chairman of Berkshire Hathaway, and Berkshire Hathaway invests in other companies. And the top 4 holdings that Berkshire Hathaway has today at the time I'm recording this video are Coca-Cola, Kraft Heinz, Occidental Petroleum, and American Express. Now, if you take a look at these 4 companies, you'll see a lot of differences and a lot of similarities. But one interesting similarity between all 4 of these companies is that each one of these 4 companies pays out a dividend. A dividend is a stock payment that a company gives you for doing nothing except owning the company. It's cash flow. So Warren Buffett owns these companies, and each one of these companies sends Warren Buffett a check every 3 months, meaning every 3 quarters. So now you might be wondering, well, how much money is Warren Buffett making from this type of cash flow? Because the real wealth that Warren Buffett has isn't how much these companies are worth, it's how much these companies are paying him every 3 months, every quarter, because that's money that he can spend, that's money that he can save, and that's money that he can invest in more companies. And so right now, at the time we're recording this video, his portfolio of companies are paying him $11 million passively. And I should let you know that that's not $11 million a year, that's not $11 million a month, that's not $11 million a week, that's $11 million a day, passively, that he's generating for not working in the company. He doesn't have to go into Coca-Cola's headquarters and produce the bottles. He doesn't have to go and make any ketchup. That's $11 million he's making a day just for owning the portfolio of companies. And these companies send him $11 million a day. Well, actually, they send him a quarterly check. They send him a check every 3 months for doing nothing except owning a portfolio of companies that make him a whole lot of money. But of course, this comes with its own risk as well. The first risk is he has to pay taxes on this money. When you make $11 million, you got to pay taxes. Now, as an attorney, who's not your attorney, what I can tell you is that when you make your money from your investments, you qualify for lower tax rates or higher tax deductions because the tax code says that when you invest your money, you deserve certain tax breaks. So the top tax rate that Warren Buffett pays on this investment income is different than the top tax rate you pay when you go to work. The top tax rate on investment income today is 20%. So when Warren Buffett makes 40-some billion dollars a year from dividends, he has to pay a top tax rate of 20%. Not the top tax rate that you pay when you go to work, because that's what the tax code says. The second risk here is, of course, growth. And what that means is when a company like Coca-Cola sends Warren Buffett millions of dollars, that's millions of dollars that Coca-Cola can no longer use to invest in branding, hire more employees, open more distribution centers, hire more truck drivers, or whatever else they need to build a business. Because when a company takes this money and they give it away to the shareholders, that's money they can't use to reinvest back into the brand. So if a company is giving this money away, they can't grow as fast because, well, that's money they're not using inside of the business. Now, this is a company decision. You might grow to a point where it doesn't make sense to keep investing back into the business, and now you want to enrich your shareholders because of the investment that they made in the company. But that's the difference in dynamic. Other companies don't want to do that. Other companies are in the growth phase, and they're not at a point where they want to or can give money away to their shareholders, so they're taking the money and they're just reinvesting all of it and some through more debt, through more investment dollars. That way the company can grow bigger, increase their market share, make more money, and be a bigger company. But this is the difference when it comes to different strategies of wealth. If Warren Buffett's stock portfolio went down, well, he's still getting his dividends. Now, maybe some companies might cut their dividends, but he's still getting paid, and he does not have to sell his stocks to get paid. He can keep accumulating more shares in more companies. He can keep investing in more companies. He can keep building his equity, building his investment portfolio, while also increasing how much money he's making every 3 months in dividends. Versus if you're looking to make more money from how much you're worth, you have to sell your stock to make money, or you have to take on debt to utilize that money. and then you take on risk. Because if that stock goes down, or if that stock goes bankrupt, you're holding onto the debt and you no longer have the asset. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.